Hello, welcome to this lesson on inflation. Inflation is when there's a general increase in the level of prices in an economy. Now, some items might decrease in price, but if the overall price level, the average price in the economy, increases, then there's inflation. So, if the inflation rate in year A is 0% and it went to 5% in year B, that means prices are going up, so there's currently inflation. When there's inflation, the purchasing power of people's money or how much money can buy goes down. If inflation increases at a very high rate, then it is called hyperinflation. It causes people's money to lose value very quickly. Then we have disinflation. Disinflation is a reduction in the rate of inflation. Prices are still rising, but at a slow down rate, at a diminishing rate. So here's how it looks like. The inflation rate in year A is 10%, year B is 7%, year C is 3%. In all 3 years, the inflation rate was positive, so prices are still rising, but it's at a diminishing rate. It's getting more controlled. It's not as high each year. That's disinflation. Then we have deflation. Deflation is when there's a general decrease in the level of prices in an economy. So if year A had an inflation rate of 0% and year B was negative 5%, that means prices are going down, so there's deflation. How do we calculate inflation? First, we got to look at a market basket. A market basket is a the value of a selection of items. Now, normally we use uh, the consumer basket to calculate the value of the items normally bought by consumers. Or there's also other baskets like the producer basket, which tracks the value of items bought by producers. Regardless, a market basket is always going to be like this. It's the current year price times the base year quantity. Because here we're going to try to look at changes in price. Again, we're going to tell you what the base year is. So here the base year is year B. So we have three items: shoes, toys, and cars. Year A and year B. Remember, year B is the base year, so we're going to use year B's quantity for everything. So let's look at year A's market basket. First, we're going to look at the shoes. We're going to use year B's quantity, which is 6, because that's the base year, times the current price in year A, which is $20 each. Plus for toys, we're going to use, again, the base year's quantity, which is 20, times the current year price in year A, which is 10. Plus, again, for cars, we're going to use the base year quantity, which is 5, times the current year price in year A, which is 10,000. We add that all up together, we get a market basket value of $50,320. Then for year B, we're going to do the same thing. Now, year B is the base year, so we're going to use its own quantity. So we're going to do year B's quantity times year B's price, because that's the current year price for year B, plus for toys, year B's quantity times the current price, which is 10, and then plus the same thing for cars, year B's quantity times year B's price. That gives us a market basket value for year B of $50,380. We have those numbers here again, same ones as before. And remember, year B is the base year, so that's important to take into account for our next step. The next step is to find a price index number. This is going to be a whole number, not a percentage, just a regular number. Um, and it's going to be the market basket in the current year divided by the market basket in the base year times 100. The most common used price index is the CPI, the Consumer Price Index, which measures the change in prices for consumers. So that might be the one that most people recognize, the CPI. Let's look at year A's price index number. We get the current market basket in year A, which is $50,320, divided by the base year's market basket, which is $50,380 times 100. That's going to give us a price index number. It's just a whole number, 99.88. Then we have year B's price index, which is going to be the market basket in year B, 50,380, divided by the base year's market basket, which ends up being the same thing, because that's the base year, times 100 gives us 100. You'll see that the base year always has a price index number of 100 because it's dividing by itself. Finally, we can look at the inflation rate, which is just a percent change in price index numbers. That's all the inflation rate is. And that's again just like before, new minus old divided by old times 100. So what's the inflation rate from year A to year B? Well, the new number is year B, so that's 100, price index number right there, minus the old price index number, which is 99.88, divided by the old price index number right there, times 100, gives us 0.12%. It's a positive number, which means prices are increasing. So there is inflation. It might be a small amount of inflation, but there's inflation. We also have other ways of adjusting for inflation. The real variable is something that's adjusted for inflation, and that's going to equal the nominal variable divided by the price index number times 100. Now, there's different types of price indexes. Like we said earlier, there's the CPI, the Consumer Price Index. There's the Producer Price Index. There's also something called the GDP deflator, which is another price index. So if you see any of those price index numbers, you're going to put that here. So here's some examples of calculating this. Example number one, find the real wage. So we're looking for a real variable. If the nominal wage, which is the nominal variable, is $300, the price index is 105. So okay, so we need the real wage. We get the nominal wage, which is 300, divided by the price index number, which is 105 times 100, gives us a real wage of $285.71. Let's look at another one. We're going to find the nominal GDP if real GDP is 500 and the price index, which is the GDP deflator here, is 110. Now here we're going to have to do some algebra because we're already giving the real variable, which is $500. That's real GDP. And that's going to equal the nominal GDP divided by the price index number, which is 110, times 100. So we do a little bit of algebra. That ends up being 110 times 500 divided by 100, and that gives us a nominal GDP amount of $550. Number three, we're going to find the price index if real income is 300 and nominal income is 500. So again, now we're solving for that price index number. We know the real is 300 and the nominal is 500. So we're going to solve for the price index. That ends up being 500 divided by 300 times 100 when we switch up the equation. And that gives us a price index number of 166.67. Next up, we're going to see where somebody is harmed or helped by inflation. So let's see who's harmed when there's unexpected inflation. First is savers, which earn a rate of return less than the inflation rate. So if your savings account gives you a 1% return rate and inflation is 5%, it's less than the inflation rate, so you're being harmed by unexpected inflation. Second, lenders, which earn a rate of return less than the inflation rate. So if a lender is charging you 5% interest and there's 10% inflation, that lender is being harmed by the unexpected inflation. Finally, people with fixed incomes, they're getting paid the same amount. If there's unexpected inflation, they're going to be harmed because their purchasing power is going to decrease. Who's helped when there's inflation? First, are borrowers, which pay an interest rate lower than the inflation rate. So let's say that your interest rate is 3% on your loan and unexpected inflation is 10%. You're actually a little bit helped by that because you're paying back less real value because of inflation, because prices have all been ballooned up. Second one are businesses that can raise prices faster than the cost of their resources. So if a business can increase the price of their product faster than the cost of their resources, then they're helped when the prices they're able to increase generate them more profit. That's all for this lesson. See you next time.